In 1929, margin debt ballooned to 8% of the entire United States economy. Then, in weeks, the market lost 85% of its value, and 10,000 banks were wiped out. Most think a crash like that belongs to history, but an 89-year supercycle has been quietly steering financial catastrophes, repeating itself across generations. Now, record global debt and evaporating liquidity signal that this hidden pattern may be triggering again, setting the stage for 2026. How does a forgotten theory from a Soviet economist connect the disasters of the past to the risk staring us down today, and what evidence suggests the countdown's already begun? Nikolai Kondratiev was a Russian economist in the 1920s who set out to understand why capitalist economies rise and fall across generations. He pored over decades of data, commodity prices, wages, interest rates, trade volumes, searching for patterns that outlasted any single business cycle. What he found was a rhythm deeper than the typical booms and busts. Kondratiev described a long wave lasting roughly 40 to 60 years, divided into 4 distinct phases. Spring is a time of expansion when investment, employment, and optimism climb together. Summer brings overheating with capacity strains, inflation, and the first signs of distress. Autumn follows as a plateau or a mild recession, where growth stalls and debt from the previous boom weighs on the system. Then comes winter, the harshest phase, marked by falling prices, mass unemployment, and the purging of bad debt. Hard numbers guided Kondratiev more than ideology. He tracked these waves from the Industrial Revolution through the early 20th century, noting how each cycle was shaped by new technologies and capital flows. The downturn, or cycle winter, was not just a stock market crash. It was a broad contraction in output, trade, and confidence. Kondratiev never claimed these cycles were strictly financial, or that they followed a fixed timetable. Instead, he argued that when expansion reaches saturation, when credit and investment cannot be stretched any further, a systemic reset becomes inevitable. The most dangerous feature of this pattern is not only the buildup of risk, but the way each new generation forgets the lessons of the last collapse. As the memory of crisis fades, optimism returns, and the cycle repeats. Kondratiev's schema offers a lens to spot systemic risk long before panic sets in, a model that can be tested against the historical record, and perhaps against the present moment. Margin debt in 1929 reached $8.5 billion, 8% of the entire U.S. economy. Wall Street's fever ran on borrowed money, with brokers lending at 90% leverage. For every $1,000 put down, a speculator controlled 10,000 in stock. The market soared on this foundation of credit, fueled by a belief that the good times could never end. RCA shares jumped more than fivefold in a year and a half, while company profits barely budged. On October 24th, panic selling began. Phones rang off the hook as brokers issued margin calls, demanding cash that investors did not have. Forced liquidations triggered a chain reaction. By October 29th, Black Tuesday, the market collapsed. Ticker tapes lagged hours behind the chaos. In just weeks, 85% of stock market value was wiped away. Fortunes vanished, and with them, the savings of millions. Banks had loaned freely against inflated assets. As stocks crashed, collateral evaporated. 10,000 banks failed between 1930 and 1933. With no federal insurance, depositors lost everything. Credit dried up almost overnight, and the economy spiraled downward. Irving Fisher, one of the era's most respected economists, declared days before the crash that stock prices had reached what looked like a permanently high plateau. His confidence echoed the mood of a generation that had forgotten winter always follows autumn. The cycle's harshest phase had arrived, and the consequences would echo for a decade. In the years leading up to 2008, Wall Street's new engine of growth was built on layers of complexity and risk. Mortgage-backed securities, bundles of home loans sliced and sold to investors, became the bedrock of the financial system. Banks and hedge funds used these instruments to borrow at astonishing levels, reaching leverage ratios as high as 30 to 1. For every dollar of actual capital, they controlled $30 of exposure. This hidden leverage ran through the shadow banking system, where overnight repurchase loans and off-balance sheet vehicles masked the true scale of risk. Michael Burry, a relatively unknown hedge fund manager at the time, began to dissect the fine print of subprime mortgages. His analysis revealed that many of these loans were destined to fail, but few in the industry listened. As home prices stalled and defaults ticked up, the complex web began to unravel. Lehman Brothers, once a titan, collapsed under the weight of its own leverage in September 2008. The market fell into freefall. By March 2009, the S&P 500 had lost 57% from its peak. Panic spread through the global banking system as confidence in counterparties evaporated. Short-term funding dried up, forcing banks to sell assets at any price. The Federal Reserve and the Treasury launched emergency programs. The Troubled Asset Relief Program injected $700 billion in capital, and a series of unprecedented interventions flooded markets with liquidity. Quantitative easing followed, as the Federal Reserve purchased trillions of dollars in bonds to stabilize the system. These measures halted the immediate collapse, but they also prevented a full clearing of bad debt, setting the stage for new imbalances to build beneath the surface. Global debt has reached an all-time high, now exceeding 350% of world GDP. Central banks spent years pumping cheap money into the system, but the era of easy credit is over. As interest rates climbed after 2021, liquidity began to vanish from the financial system. The cracks are most visible in commercial real estate. In 2023 and 2024, regional banks such as Signature Bank and First Republic Bank faced sudden funding crises after a wave of loan defaults on downtown office towers and shopping centers. Internal bank memos documented how a single missed payment could set off a chain reaction, raising funding costs for dozens of lenders in just days. The stress is not limited to property. Stock valuations have soared far above historical averages, while bond prices remain inflated after years of central bank intervention. Housing prices have also detached from wage growth, echoing the speculative fever seen before the last two crashes. Meredith Whitney, who warned about bank fragility before the 2008 collapse, has raised alarms again. She points to shrinking liquidity, rising defaults, and the dangerous overlap of bubbles across multiple asset classes as signals that the system is running out of road. Regional bank funding costs are surging, corporate defaults are up, and the safety net of easy money is gone. The numbers suggest a system stretched to its limit, with risk concentrated in places that regulators and investors once considered safe. The fuse is burning, and the warning signs are no longer hidden in the footnotes. They are front and center, flashing red. Every major boom has its chorus of believers convinced the old rules no longer apply. In 1929, faith in new technologies and modern finance drowned out warnings of excess. By 2007, complex risk models and global diversification gave investors a sense of invincibility. Today, the story repeats. Warnings about debt and overvalued assets are brushed aside in favor of narratives about innovation, central bank backstops, and regulatory safeguards. The collective memory of crisis fades as new generations take the reins, unburdened by the scars of past collapses. Political leaders and industry experts reassure the public, delaying hard choices and reinforcing the illusion of control. The cycle persists not just because of numbers on a balance sheet, but because of a stubborn belief. This time is different. Cycle math puts the next reckoning squarely in the window of 2026. The arithmetic is simple. The 1929 crash plus 89 years brings us to 2018, the year the Federal Reserve began draining liquidity from the system. The same period saw the first yield curve inversion since the run-up to the last two major crises, an early warning that credit was tightening. Add to that the 18-year real estate cycle, which predicted the 2008 crash, and now converges on 2026 as its next peak. Defaults are rising, liquidity is being pulled from markets, and commercial real estate is buckling under higher rates. These are not distant signals, they are unfolding in real time. The same markers that flashed red before previous collapses are now visible on every dashboard, suggesting that the countdown is already underway. Right now, global debt exceeds $307 trillion, a record high. As liquidity tightens and warning signs multiply, the cycle's lesson is clear. Denial never breaks the pattern. The next collapse is not a prediction, it is a consequence. Every generation faces the same choice: recognize the signals or repeat the cost.